Welcome to the second module of this course when we talk about debt instruments and interest rates. In this first module, we're going to discuss bonds in particular and look at some of the bond specifications. The readings for this module come from Investopia, article called Advanced Bond Concepts, and there's sections of it that I want you to focus on. While you're reading this Investopia Advanced Bond Concepts article, I want you to only focus on the equations I present in modules or in class. There's quite a few details in this Advanced Bond Concept article that we will not have on the test, and in fact they're very easy to calculate in Excel, so I'm not going to be making use of the formulas. So if you see a formula in that reading and it's not in a module, well, then we're not going to be responsible for it on this test. This module this reading does a nice job of laying out some of the material that we are going to cover in these coming weeks. What we are specifically going to be looking at is debt instruments. Our first module focused on equity. Now we are going to look at debt instruments. And these are debt obligations. And some of the ones that we are going to look at are debt obligations of sovereign governments. And here we're going to focus mainly on U.S. Treasuries, although we could focus on Euro or any other sovereign government issue. The main feature of sovereign government issues is that supposedly there is no default risk, although we might be testing that here in the United States here shortly. Municipal debt. This is the debt of municipalities, which is more broadly defined than just cities. It would include states, cities, and local bodies. Those local bodies might be water districts or sewage districts. The final one that we'll be looking at is corporations. Also within this general classification is mortgage-backed securities, and then there's other backed securities as well, but we'll spend a little bit of time on mortgage-backed securities, which are mortgages bundled together. So those are the types of debt instruments that we will be looking at. One of the key things here is that all of these debt instruments have a schedule of interest payments and payments in them. The interest or the coupon portion, as well as the payments of the principal. There is no upside. The only thing that exists on these debt instruments is downside risk or the probability of default. As we evaluate risk from these bonds, again, what we are very concerned about is default. And the default is a failure to make a scheduled interest or principal payment. And it's important to note here that default does come in different severities. For example, a default is missing a payment by a day. So if you're late by a day, that in theory is a default. It doesn't necessarily indicate the loss of principal that may happen, but in the worst case scenario, a default would be total loss of all payments from there on. In this risk measure, credit ratings are fundamental looking at default risk. So looking at the underlying quality of the organization that lent out the money is key in determining that default risk. Much of the time in this class we are going to be focusing on bonds, and bonds are a specific form of debt. They have very fixed specifications and they are often traded on secondary markets. So bonds would include the Treasury, notes and bills and bonds that we are going to be looking at. There's a secondary market for those that traders or an owner of a bond can sell it to another buyer. So that's what that secondary market does. Again, some of the fixed specifications of those are going to be covered on these next two slides, as well as covered on pages 2 through 5 of the reading. So for more detail, and you should read this, pages 2 through 5 of the reading will give you more detail. Some of the specifications include number 1, the bond issuer, government, municipality, or corporation. We've already discussed that prior to this. Municipality, again, includes state governments, city governments, and other local bodies such as water districts. Second specification is the priority. And there's essentially two broad types, unsubordinate debt and subordinate debt. Unsubordinate debt would be first in line. If a firm, if any of the bond issuers go in bankruptcy, it would be the one with the first debt holder that would get paid. Subordinate or junior would get paid after senior debt is paid, and there can be various degrees of subordinate debt. So that unsubordinate and subordinate debt is particularly the subordinate debt isn't clear. There could be varying levels of subordinate debt. Again, what you get concerned about in priority is in case of default, and in particular leading then to bankruptcy, when will this bondholder, what sequence it will get paid? Generally speaking, the higher up the line the debt is, the lower the risk and the lower the interest payment. So unsubordinate debt would be less risky than subordinate debt, all else being equal, because it's first in line in receiving that payment. Third specification is the coupon rate, and you see four types there. Fixed rate. Fixed rate is also called straight or plain vanilla. Here you have a fixed rate, say 3%, and it doesn't change, move up or down. It is known, it is a fixed rate. Alternative to that is a floating rate, which will move up or down based on some index or some other measure. There's also inverse floatable rates, which will move opposite of a index, and then there is zero coupon. Zero coupon do not have any interest payments. So the coupon rate is the rate at which, or the interest rate at which these bonds will make payments. Final characteristic is redemption features. And let me just talk about three of those redemption features. Callable means that the issuer of the debt can call that debt back at specified times or perhaps at any time. So the callable debt gives the issuer the right to repay the par on that debt bond at any time. Convertible means that debt can be converted to equity at either specified points at time or at any point in time. And putable means is that the holder of the bond could at any point in time or at specified points in times get their par value or their principal payment out of that bond. What we're going to do now is focus on a particular type of bond, and that's treasuries. So what I'm going to do now is give the specifications for a treasury bond. First, there are several different types of treasury based on the length of time to maturity. Bonds are 10 years plus from maturity. Notes are 1 to 10 years, and bills are less than 10 years. So if you see that we're looking at bonds, you know it's a lengthy maturity. Notes 1 to 10 years, bills less than 1 year. The bond issuer in this case is the U.S. government. It's called Treasuries because it's operated out of the Department of Treasury. So the U.S. government is the issuer of this bond. Priority is first in line. Supposedly, sovereign debt is one of the safest types of debt. Presumably, the federal governments will not go default on this type of debt. They'd rather than going default, print money. So it's often looked at as a low um, risk debt. There's very little chance that there will be default or non-payment of payments on the treasuries. Although again, that is a, that is not for sure. And in certain cases in history, we've seen governments go default on bonds. Coupon rate, bonds and notes are straight plain vanilla. It's a coupon rate, it's a fixed rate. Bills are zero coupon, and we'll give an example of that. They're discount bonds, and again, we will give an example of that. And finally, the redemption features, there are none. So these are one of the simplest bonds that we can look at, and we'll give you a couple of examples of those in the next couple of slides. Now I'm going to give a particular Treasury note example. This Treasury note has a par value of 1,000, which is the usual beginning size of Treasury notes, and you can get them $1,000 to much larger. Par value, you'll see the meaning of that or what it's used for here in a minute. It's used to calculate the interest or coupon payments as well as give the payment at the end. This is going to be a 2-year note example, and all Treasury notes and bonds, or anything over a year in length, is going to make semi-annual payments. So there will be 2 payments per year, 6 months apart, and the coupon rate is 4% in this example. The way these notes and bonds work is they take the coupon rate divided by 2 to come up with the semi-annual payments. So there isn't any fancy compounding going on here. There is just a coupon rate, 4%, divided by 2. So we get 2% in the middle of the year and 2% at the end of the year. And in this example, there will be 4 semi-annual coupon payments. The principal, and now we'll get to the payments themselves. There will be 4 coupon payments. These will be, again, $1,000 times the 4% coupon rate divided by 2, which will give us $20. And then we'll have a principal payment of $1,000 at the end of the payment, at the end of the 2-year period. We are now in Excel, and I'm going to give a visual example of those payments of this 2-year Treasury note right here. Again, our 2-year Treasury note has a coupon rate of 4% and a $1,000 par. This bill is going to make 4 payments in 0, 2, 3, 4 semi-annual periods. And this is going to be key a little bit later on, not in this slide, but in another module. This happens to be a half year in the future, 1 year in the future, so 2 periods is 1 year, 3 periods is 1.5 years, 4 periods in the future is 2 years. In the first 3, we're going to get a $20 payment, which is our $1,000 par times 4%. So this equals $1,000 times 0.04 divided by 2. And that's what they're all going to equal down here. Plus at the end of the 4th period, we get our par $1,000 back. So those are the payments associated with the Treasury note, 2-year 4% coupon rate. I'm now going to give a Treasury bill example, and a Treasury bill is any Treasury with a maturity of less than 1 year. These bills have 1 payment at the end of the period. Here in my example, I have a bill with a par value of 1,000. The coupon rate is 0%, which means there is no interest payment. There's only 1 payment of $1,000 at the end of the period. What that means is that you will bid less than $1,000 and then get $1,000 at the end, and the difference between those, the price and the par, is the interest payment for holding that bill. These bills, or any bill without a coupon rate, is called discount bond, and just because the discount bond um, means that you're going to discount the price to get the par value of 1,000 and the desired yield. In my example here, we have a payment in 6 months. So the red here, we have this Treasury bill example, and all bills will only have one payment of $1,000 in 6 months. Right over here, I give an example of the 6-month Treasury bill, and again, this is a very simple example. It has $1,000 par. We have one period, half a year from now, $1,000 payment. So, what I've done in this module is just giving you a definition of bond types and some of their common specification, as well as specified payments on treasuries. We're going to use those treasury specifications in the two examples I gave in this module to calculate, in our next two modules, to calculate both yield to maturity and duration.